Welcome to Retirement Straight Talk with Paul and William, featuring award-winning financial advisor and former host of the Sunday Money Show, News Talk 1010, Paul Baraka, and his associate advisor, William Baraka. Creating and keeping wealth does not need to be complicated. Paul and William will cut through confusing and contradictory financial advice to give you the real facts to help you invest better and enjoy a worry-free retirement. The views and opinions expressed in this video may not necessarily reflect those of IPC Securities Corporation. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.
And hello, everyone. Welcome to, I think it's episode number 13 in Retirement Straight Talk with Paul and William. I'm Paul, the good-looking young fellow on the other side of the screen is William. And today we're going to talk about 2022, one of the worst financial years on record. Miserable year. Stocks were down double digits. Bonds were down double digits. Real estate was down double digits. There was really no place to hide. And there's some things, I think there's some things we can all learn from, things we probably knew, but it's good to bring them back again. And I was reading one of the more intelligent and interesting bloggers, a fellow named Ben Carlson in the States. He wrote some things on this, and I'm going to kind of go through and talk about some of the things that he said and add my own kind of flip on it. First thing is that we can learn from last year is that anything can happen in the short run. And this is key, even things that have never happened before. I don't know, you've heard about the book, The Black Swan. It was, I forget who wrote it, about the things that we never think will happen will often happen. And that's the case that happened last year. For example, no one thought that last year, both bonds and stocks would be down double digit. It's never happened before. Never happened before. As a matter of fact, there are only 3 years historically before last year that both bonds and stocks since 1928 went down in unison. Wow. Last year, the S&P lost 18%. The aggregate bond index lost 13%. Even U.S. Treasuries, risk-free investment lost 15% in 2022. It's been said that, history doesn't repeat itself, but it often rhymes. And the economics is an incredibly complex system. It just evolves and mutates far faster now than it ever has before. Anything can happen in the short term, even things that have never happened before. So that's maybe rule number one, anything can happen. Rule number two is, predicting is kind of hard, predicting forward. Who would have guessed back, a year and a half ago, 2 years ago, that inflation would rise to 7%? Who would have guessed that mortgage rates would have skyrocketed almost overnight? And of course, Russia invading the Ukraine. Who would have predicted the pandemic a few years ago? Who would have predicted the financial crisis? And the list goes on and on and on. My guess, a year or so from now, we will, and the world will experience a number of events that will have a big impact on the economies, investment markets, interest rates, and we couldn't even imagine them today.
Well, Paul, even the experts can't predict these things. If you look at, you mentioned inflation and interest rates. The Fed was in an effort to tamper down inflation, began raising interest rates. But for a while, they said inflation was transitory and that there's no problem with it. They said it's all due to supply chain issues. There's no problem here. No need to raise interest rates. They kept buying securities in the market in order to prop up the credit market until all of a sudden they realized, we're wrong. And they had to begin the fastest interest rate increases since the 1980s. So like the people at the Fed, these are all the smartest people out there. They've got access to the greatest data that would theoretically allow them to predict this stuff, even they get this stuff wrong all the time.
That reminds me of in 2008 in March, then President Bush of the United States. By the way, remember 2008 was the year of the financial crisis that fall, where everything almost collapsed. 6 months before that, then President Bush had a meeting with the 30 leading economists in the US. Every one of them said, this year will be okay. So that tells you, if you start listening to economists and people in the media predicting things, oh boy, I wouldn't want to base my financial future on that. So that's great. That's item number 2 that we learned. Item number 3 is nothing works forever. Hey, it's been said, and this is a quote, an old saying, nothing fails quite like success on Wall Street, because expectations are so high that it becomes nearly impossible to continue to outperform what investors think will happen in the future. I mean, look what happened last year. I mean, in the 2010s, technology shares for 10 years, they did fantastic. Apple, Amazon, Facebook, Google, all these companies, they earned for probably 10 years outsized returns every year. But look what happened last year. Nothing stays the same forever. Last year, Apple down 30%, Amazon down 56%, Facebook down 76%, Google down 44%. It just goes on and on and on. Now, it's not to say these companies aren't bad. My guess, most of them are probably going to do pretty well in the future. But not, I guess maybe that's another reason why diversification makes a lot of sense.
And also, don't chase performance, right? Too often we see people buying things just because they've gone up in the past. And again, just because something's gone up in the past doesn't mean it'll continue to do so. In fact, if you're basing your investment strategy on just buying the high flying things that again have done well recently, you're probably buying them at the exact wrong time after they've already gone up enough. Probably a sign that it's not going to continue forever. Like you said, good things don't last forever. Fads come in and out.
Yeah. It's interesting because when people come into our office and we talk about investments and we make a recommendation, they'll often ask, well, how is it done in the last few years? And our response is, it doesn't matter. Actually, statistically, they've done analysis, and top performing funds for 5 years, over a 5-year period, tend to be the worst performing funds in the following 5 years. And that's not that happens quite often. So again, your point is right. Don't worry about what's happened in the past. So that's number 4 in terms of, that's the third item we could learn from last year. And the fourth one is something we all know, but we need to be told it again, that market losses will happen. They'll continue to happen. I mean, again, last year was a rotten year, but the 3 years before were pretty darn good years, double-digit returns for the most part for 3 years in a row. Hey, that's pretty darn good. And if you look at, excuse me, 1928 through 2022, the average U.S. market increase has been 8.9% per year. And again, some years are rotten, some years are much better. But that, if you can earn an average 9% a year, you're doing pretty darn good. So again, the secret is, again, you want to look at the big picture, take things, because you're investing for the long period. Invest like people do in real estate, where they buy a property and they look at it for 10 years. Or if you invest in a business, you don't look at a business and put money into it and, well, I didn't make money this year, so I'll sell the business. You look at it for long term. You look at your stock portfolio the same way. And if you do that, you're probably going to do pretty good.
Exactly. Like it doesn't, in the 3 years prior to the last year, in 2019, the US stock market, the S&P 500 went up 31%. In 2020, it went up 18%. In 2021, it went up 28%. It'd be great if that could happen every year, but that's not the case. We're always going to have a bad year like we did last year. Every once in a while. It's easy to forget that when you're going through several straight years of really good markets. It's easy to get caught up in that. But But again, just look back historically, you're always going to have these bad years, and position yourself, by the way, expecting that sort of thing, that not when or if it will happen, or sorry, not if it will happen, but when it will happen. So important when we're in bull markets, it's important not to get caught up in it. Don't change your risk profile to get more aggressive, because again, these bad years inevitably will come. And it's also
that's
important.
A good point. Well, that's a really good point, because some people come to us in a bad year and they want to revise and have their
the opposite's true
conservative. It's up in the exact wrong time to do it.
Yeah,
but it's our
absolutely.
natural.
And also important to always don't invest short-term money. That's another lesson from last year. It's really painful, again, when you go through so many good years of stock market gains, to have money sitting in cash saying, oh, I could be earning this amount on this cash if it's invested. But last year is a good reminder of the value if you don't invest your short-term money. If you're saving up for something in the next year, couple years or so, don't invest in the stock market. Only invest your long-term savings.
Bingo. And last thing too, I just wanted to add, I mean, we all listen to the media, and the media is always talking about the volatility in the market. Oh, in this volatile market, you hear it all the time. And I think, why are they saying that? The market is always volatile. It's always volatile. It's not just volatile today. It's volatile before. Any period in time, it's always volatile. It's almost like going to look at the ocean and going, oh, look at this wavy ocean. It's wavy today. It's ridiculous. The markets are always volatile, and they will always be volatile. So that's probably not a bad place to end things up, William. Just a quick summary. Again, some things to watch for that we could have learned from last year. Anything will happen and can. Number 2, predictions don't work. 3, no strategy ever works forever. And number 4, market losses are normal. Markets are always volatile. So if you like what you heard today, hey, you know what? Rate us and subscribe to the podcast so you don't miss any in the future. And next podcast, we want to talk to the business owner again. If you're a business owner, an incorporated business owner, you want to listen to this, we're going to talk about the super RSP available to business owners. Really neat idea. And if your business is appropriate for this, boy, it can be massively beneficial for you.
Sounds good. Thanks, Paul. We'll chat next week.
Okay, great, guys. See you soon. Bye-bye.
This podcast was brought to you by West End Wealth Planning, an award-winning wealth planning practice catering to small and medium-sized business owners and to those looking to create a worry-free retirement for themselves and their families. To learn more, go to westendwealth.com. Don't forget to rate this podcast and subscribe to Retirement Straight Talk with Paul and William by going to Apple Podcasts, Spotify, or wherever you find your podcasts.